So what do you do if you want to buy a house? But with today's higher interest rates, the monthly mortgage is just a little bit out of reach. Well, in today's video, we're going to discuss 3 very powerful options that will help you save money on your monthly mortgage, and depending on the option, could save you thousands of dollars over the life of the loan. But before we get into it, do me a favor, like the video, it helps a lot. Subscribe to the channel, we're gaining momentum and we're gaining popularity. But wait till the end of the video and I will give you some ideas that will definitely save you some money, and I'm sure you've never heard them before explained quite this way. So here we go. So I work with a lot of different home buyers. And with today's interest rate at 6.3%, which is not necessarily a bad rate, it's just with the higher home prices, the two together might make it a little bit unaffordable for the monthly mortgage payment. So I usually tell my clients that they have some options to lower that cost. One of them is points.
All right, mortgage points or discount points are essentially a cost for an interest rate. And what will drive that cost for the discount point and the associated interest rate is going to be a lot of different factors. So it's going to vary based on the lender. It's going to vary based on the loan program. It's going to vary based on your credit score. It's going to vary based on what your overall goal is with your home loan. And this is really important. So as Dave Ramsey likes to say, do not pay discount points. Well, I think that Dave, in a lot of cases, is right, and in some cases may not be right. So really, as we're helping people to kind of evaluate, does it make sense to buy an interest rate down by paying discount points?
So what is she talking about? What does it mean to buy down the rate? And what are points? Well, remember, banks are profit-oriented, risk-adverse. They don't know what the rates are going to be 30 years from now. They don't even know what the rates are going to be next week. So what the banks do is they build in a premium into a 30-year fixed loan in order to guarantee a slightly higher rate of return. But if you tell the bank, I don't like the rate that you're charging me, I want a lower rate, then one of the ways to do that is called a rate buy down. And all that's really saying is, I will give the banks some of their profit up front. How much? A point. What is a point? A point is literally 1% of your loan amount. So for example, if you have a $500,000 loan amount, then the point's going to cost you $5,000. And the question is it worth it? Well, the math of the situation is actually pretty simple. Let's say that the point saves you $100 a month, only for example. And it cost you $5,000 to buy that point. So if it's saving you $100 a month, how many months, $100 will it take to equal $5,000? So if your plan is to be in that home or in the loan for longer than that break-even point, then it absolutely makes sense. And if shorter, then you probably shouldn't do it. But generally, it's not a bad idea, and it's a great way of lowering your monthly mortgage. And if you stick to the end of the video, I'll give you some tips on how to do it for free. The second idea is called an ARM, an adjustable rate mortgage, but a specific type of ARM, a 5-1 ARM, a 7-1 ARM, or a 10-1 ARM.
What is an adjustable rate mortgage? What is an ARM? How do they work? What are the pros and cons of an adjustable rate mortgage? In today's video, we're going to dive into Mortgage 101 on adjustable rate mortgages, help you understand the pros, the cons, the risk, and when it actually makes sense to consider using a short-term loan like an adjustable rate. Because interest rates have risen to multi-year highs, peaking over 5% for many well-qualified buyers out there, affordability is starting to come into play for many potential home buyers because they can't afford as much house as they could just a couple of months ago. So now they either have to consider looking at homes that are less expensive or potentially use an adjustable rate mortgage, which in many cases may come with a lower interest rate, allowing them to qualify for more home.
So here's how it works. If you have a 7-1 ARM, what that means is the rate is fixed for 7 years. And in year number 8, it will adjust one time. And then it will adjust one time every year thereafter until you hit the maximum rate cap. So it's not as volatile as people think. And if you're not going to stay in your home for 30 years, then it can save you a lot of money. Option number 3, interest-only loans.
We're going to talk about interest-only mortgages, what they are, an example with the difference in cost compared to a typical mortgage, and why you may or may not want one. Interest-only mortgages are as they sound. You are actually just paying interest only back to the bank rather than paying principal as well. So your principal balance isn't decreasing as you are making payments, and you are just paying interest.
Okay, so how does it work? So an interest-only loan means that you're paying the interest portion of the mortgage to the bank, and you're keeping the principal part. So the money that you're saving is actually going into your pocket instead of going into the property. Essentially, you're taking your equity up front. And what you can do with that money is invest it so that you're making money on your money. So like, for example, a 12-month CD, corporate bonds, where you're actually making anywhere from 5 to 8% return on your money. So for a person who's not going to stay in the home for 30 years, it's not their forever home, this might be a really, really good loan because it's the lowest possible payment and the highest possible tax deduction. And the benefits are very strong. And like I said, you've already taken out your equity, so if something happens to the home or you can't afford it and you have to walk away, that equity that you would be putting in the house and have to sell to get out, you already have. So now you have 3 extremely powerful tools to lower your monthly mortgage payment and leverage the bank instead of the bank leveraging you. You have points, which pays the bank an upfront fee to lower your rate. You have ARMs, which lowers the bank's exposure to time, therefore lowering your rate. And you have interest only, where you only pay the interest portion of the loan. The money that you save, you're reinvesting in other vehicles so that you can make money on your money. So in conclusion, if you're not going to stay in the home for 30 years, and it's not your forever home, then these 3 vehicles, points, ARMs, and interest-only loans, can be very powerful. They can lower your monthly payment, allowing you to buy the home you actually want at a more affordable price. Sometimes you can even get the seller to pay your closing costs and allow them to pay for your points. There are so many ways to use finance and leverage to achieve your goal of home ownership, and that's how you get it done. Well, that's the video. Thanks for watching. Like the video. Leave comments. Let me know whether you agree or disagree, whether you like or don't like the topics that we've just discussed. Subscribe to the channel for more content on real estate, and we'll see you next time.